Today we're diving into the world of bonds, a critical component of the financial markets. We'll explore what bonds are, how they work and why they're important for both issuers and investors. Remember, the video is for educational and entertainment purposes only. It is not financial advice. A bond is a type of security under which the issuer owes the holder a debt and is obliged to provide cash flow to the creditor. Essentially, a bond is a form of loan or IOU. The issuer can be a corporation, municipality or government, and the bondholder is the lender. Bonds are issued to finance long-term investments or cover current expenditures. In return, bondholders receive periodic interest payments known as coupons and the principal amount when the bond matures. While both bonds and stocks are securities, they differ significantly. Stockholders have an equity stake in a company and are owners, whereas bondholders are creditors. In the event of bankruptcy, bondholders have priority over stockholders but rank behind secured creditors. Bonds come in various forms, including municipal bonds, corporate bonds, and government bonds. Some are negotiable and can be traded on the secondary market, making them highly liquid. Others, like certificates of deposit and commercial paper, are short-term instruments and not classified as bonds. Bonds are issued in the primary markets by public authorities, companies, and supranational institutions. The most common process is underwriting, where securities firms buy the entire issue and resell it to investors. Alternatively, government bonds are often issued through auctions. Bonds have several key features: the amount on which the issuer pays interest and which is repaid at maturity, the length of time until the bond's principal is repaid, the interest rate paid by the issuer, which can be fixed or variable. The yield is the rate of return received from investing in the bond. There are different measures of yield, including current yield and yield to maturity. Yield to maturity takes into account the present value of future interest payments and principal repaid at maturity. Bonds are subject to various risks, such as interest rate risk, credit risk, and reinvestment risk. The market price of a bond can fluctuate based on these factors. When market interest rates rise, bond prices typically fall, and vice versa. Bonds are primarily bought and traded by institutions like central banks, pension funds, and insurance companies. Individual investors typically invest in bonds through bond funds. Bonds are generally viewed as safer investments compared to stocks due to lower volatility and fixed interest payments. Bonds play a crucial role in the financial markets, offering a way for issuers to raise funds and providing investors with a stable income stream. Understanding how bonds work can help you make informed investment decisions. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.